In the past few years, we've experienced the worst outbreak of inflation since the 1970s. The rate of inflation in the US has gone from practically zero to as high as 9.1%. And yet the prices of precious metals have hardly moved. An ounce of gold, for instance, is trading nowadays for almost the same price as it did during 2020, and only 10% more than it did 12 years ago in 2011. For silver, the situation is even worse. It is still trading for less than half of its 2011 high. Does this mean that precious metals have lost their charm? Do they no longer function as a hedge against inflation? Inflation is a concept which many economists are struggling to understand. Even Fed Chair Jerome Powell has admitted so during a panel discussion which took place in 2022. But inflation is actually very easy to understand, provided that you are using the correct definition. Inflation is simply the expansion of the money supply. Unlike what most economists believe, inflation is not a rising price level. First, because prices are not level. Certain items may react differently to inflation than others. But more importantly, rising prices are the outcome of inflation and not inflation itself. There was a time in which every economics student would know that. But the definition has been altered due to political reasons, in order to absolve the governments and the central banks from any responsibility for inflation. As Milton Friedman used to say, inflation is always and everywhere a monetary phenomenon. Once we realize that, we can easily identify the culprits. In our current monetary system, there are two ways in which the money supply can grow. The conventional way is by banks handing out loans to corporations or to private citizens. As amazing as it may sound, banks do not loan out their reserves, or even their customers' deposits. Under the fractional reserve system, banks are allowed to loan out money which they create out of thin air. The more loans they make, the more currency there is in circulation. In the past, banks were required to keep a certain amount of reserves at the central bank, as a percentage of the overall loans that they could give. But this requirement was cancelled in 2020. And today they can theoretically loan out an unlimited amount of money and generate an unlimited amount of inflation. The only boundary on the sum which the banks can create is the actual demand for credit. The second way in which the money supply can grow is through a process called quantitative easing, in which the government issues bonds, and the central bank purchases these bonds using money which is printed out of nothing. Many economists argue that QE is not inflationary, because the central bank buys these bonds from the commercial banks and not directly from the treasury, and that in return for these bonds, the banks receive bank reserves, which they are not allowed to spend, and as we've already explained, are not even needed in order to hand out loans to their customers. But these economists are ignoring the other side of the transaction. By purchasing these bonds, the central bank is creating an artificial demand for government bonds, which far exceeds what investors would normally buy. This keeps long-term interest rates low and allows the government to spend above and beyond what it is able to collect in taxes. These deficits, which are financed by money printing, are definitely inflationary. Sadly, inflation is nowadays the standard solution for every financial crisis. Whenever banks are failing, the Federal Reserve is there to bail them out with newly printed money. Whenever the stock market is crashing, it opens up the spigots and floods the markets with liquidity. Even when the crisis is finally over, the government continues to generate inflation under the guise of stimulating the economy. From a political standpoint, this is certainly the easiest course of action. Governments and central banks can appear as heroes who save the day without raising everyone's taxes. What the public fails to understand is that they are paying for the bailout through their grocery bills and through the erosion of the value of their savings. By the time they realize how inflation is destroying their purchasing power, it may be too late to do anything about it. Unlike dollars, which can be created at the stroke of a key, gold and silver are very rare, and their above-ground stock is growing at a very slow pace. Throughout human history, only about 210,000 tons of gold have ever been mined. Since gold is a monetary metal, it is reasonable to assume that most of this amount is still with us, kept safe in the vaults of central banks and wealthy individuals. The annual mine supply of gold across the world stands at about 3,600 tons. Therefore, the above-ground stock of gold is growing at only about 1.7% per year. The situation in silver is a bit more complicated. Since silver nowadays is primarily an industrial metal, more than half of its annual supply is consumed by industry. In many of these industrial applications, the silver cannot be recovered and is lost forever. This means that a large amount of the silver which has been mined throughout history is no longer available. Whatever is left exists either in investment form or in the form of silverware and silver jewelry, which can be recycled relatively easily. This amount is estimated to be about 930,000 tons. The annual mine supply of silver currently stands at about 26,000 tons. Therefore, the accessible above-ground stock of silver can theoretically grow at a rate of about 2.8% per year. But it would require industry to stop consuming silver altogether, which is unlikely to happen. Realistically, this figure can only grow at a rate of about 1.4% per year. The obvious conclusion is that gold and silver should act as a hedge against inflation. Their supply is limited, while the supply of dollars is unlimited. Therefore, their price should rise as the money supply expands. We have seen this happen many times throughout history. This is true regardless of whether we are using gold and silver as money or not, because both metals have a strong industrial demand. If for some reason their monetary demand declines, as we've seen in silver during the past few decades, we can expect the industrial demand to increase and pick up the slack. This tends to stabilize the price of gold and silver and prevent extreme price swings. So how come in recent years the price of gold and silver hasn't kept up with inflation? How come their price isn't strongly correlated with the CPI? The answer is time lag. Apparently, it takes the public a very long time to realize that inflation is eating their lunch. During the early stages of inflation, the newly printed money tends to flow into speculative assets such as stocks or cryptocurrencies. This mainly benefits the wealthy, who own the vast majority of these assets. Only during the later stages of the inflation do the prices of commodities begin to reflect the expansion of the money supply, which could have happened years before. Once the genie is out of the bottle, it is very difficult to put it back in. The central bank may try to tighten monetary policy, just as the Federal Reserve has been doing in the past 2 years. But it's impossible to absorb in a short period of time the amount of liquidity which took over a decade to generate. In all likelihood, this will only lead to a recession, which will force the central bank to reverse course and ease once again. To their great chagrin, central bank governors may discover that the inflationary fire which they tried so hard to extinguish is erupting yet again at an unprecedented intensity. At the same time, the economy will slow down and unemployment will rise. This lethal combination of inflation and stagnation is known as stagflation. This is exactly the environment in which precious metals perform best. After suffering one bout of inflation, the public becomes painfully aware of its destructive nature. At the first sign that prices are rising again, it will begin to front-run it by hoarding the commodities which it consumes on a daily basis. The increased demand for consumer goods will force their prices to rise, which will only encourage the public to hoard them even more. This creates a price spiral which feeds upon itself. In the process, more and more of the currency which was printed in prior years will find its way into the commodity sector. But since most commodities either have a limited shelf life or are difficult to store in large quantities, the public will eventually discover gold and silver. These are the only two commodities which have an unlimited shelf life and are compact enough to fit into a small safe. Unlike governments or large corporations, private citizens don't have the ability to store large amounts of wheat or crude oil. The only way they can gain direct exposure to the commodity sector is through gold and silver. Do you realize now why most economists fail to understand inflation or anticipate its outcomes? They cannot fathom how currency creation, which took place a decade ago, can impact our present-day lives. They underestimate the public's desire to protect themselves from inflation, and they forget the important role which gold and silver serve in the global economy. They assume that precious metals have lost their luster after decades in which their prices have been stagnant. They believe that cryptocurrencies have replaced them for good. But in my opinion, they are in for a surprise. Gold and silver are about to make a comeback. This has happened countless times in the past, and I cannot see why it shouldn't happen again. Thank you for listening to the Silver Hermit podcast. If you like this content, please donate in the link which appears in the description below. Please subscribe to this channel and share it with your friends and family. Hit the bell icon to be notified whenever I release a new video. Remember, I'm not a licensed financial advisor. This video is intended for general informational purposes only and should not be regarded as investment advice. Before taking any investment decision, please consult with a professional financial advisor who may assess your personal investment objectives and needs.